Hello, everyone, and happy Friday. We're here today with Gregg Busch from First Savings with our 10th episode of Ask the Loan Officer. Really happy to have you here today, Gregg.
Hi, how are you, everybody?
I've done a lot of deals with Gregg, and I've known Gregg for a very long time. How long have you been in the business, Gregg?
So I've been in the business. I got in 1988. I think I've been in like 32 years.
Wow. So
Long time.
You've seen it all.
I've seen the market gyrations. When I started in the business, interest rates were about 13.5%.
And now we're panicking if they're going over 5.
Now we're panicking if we're going over 4.5, although interestingly, they're coming back down a little bit with gyrations in the stock market.
I love it.
Yeah.
All right. Let's get off to our first few questions. I want to show our viewers what a $450,000 purchase payment looks like. I know that's it's a little on the lower side, but let's keep it realistic for some of the new buyers.
Okay.
Tell us a little bit about that.
Okay, so first I just want to mention that I've been a resident in Washington pretty much all my life in the business of originating mortgages. I've been living here for a little over 30 years. I'm married to my partner slash developer, Brooke Rose, and we've got one 5.5-year-old child.
So cute.
He's adorable. But
I love those pictures.
So what's happening now is that as we're seeing the upper end of the housing market slow down a tad, the first-time homebuyer business in Washington has really become the focus of what not only the city, but clearly the federal government wants to see more in the economic growth, more people buying homes. And to do that, you have to have products out there that look attractive. One thing that's so fortunate about the DC market, and now I'm just talking about Washington, DC itself, is there's a lot of great first-time homebuyer incentives to make it look or feel and see that renting is actually more expensive than owning. So what Mark had just mentioned was a sales price of $450,000. And I was going to mention our Fannie Mae and Freddie Mac have first-time homebuyer programs. There are income limits in certain areas, but in other areas, depending on census tract, there's no income limits. So let's say, for example, you want to buy property somewhere along North Capitol Street, somewhere in Bloomingdale. You could pick up a $450,000 condo, put 3% down. 3% is roughly about $13,500. And you could, for example, today, interest rates for 30-year fix is 4 3/8. Adding your taxes, your condo fee, and your mortgage insurance, the payment would be close to $3,000 a month.
All right. And $3,000 a month around here is, a one-bedroom den.
Right. But here's the exciting part, Mark. The exciting part is after the tax benefits, just right off the bat, if you take the federal tax interest off and increase your withholdings, so less money is coming out of your pay stub, that payment is actually net effective $2,450.
That's a huge difference. I did that the first year that I purchased. At the end of the year, we got back like $7,000 or just something really crazy. So I went to my accountant and I said, is this the way that it's going to work? And he said, just increase your exemptions to 2 and you won't have to wait to the end of the year to get that. I was like, are you sure? And then the next year I was even, but I got a chance to get more money in my paycheck.
Exactly. And why let the IRS collect your money and hold it till the end of the year till you get a refund the following year? Why not use it towards your mortgage and pay your interest and maybe even make an extra payment on the 12th month of the year to, get more of, buy down towards your principal?
Yeah, that's always important if you can do it. I have a lot of clients that are doubling up, just taking advantage of these low rates.
Right. And then just, on top of the Fannie Mae, the first-time homebuyer program, and Freddie Mac of 3% down. There's also a program that's been introduced, and it's done through our DC Open Doors down in our Housing Administration office here in DC. It's called a mortgage credit certificate. And if you qualify for the mortgage credit certificate and you hit the maximum household income, and it's very reasonable, you also get an additional amount of money off every year in interest. So let's say you do hit that number. And again, I don't want to get too detailed with numbers and dollars and cents, but in this scenario of this property, that's an additional $316 off if you qualify.
Oh, well, that's sizable. So we already got back down to the $2,400 range, right?
$2,456. That's $316 roughly if you qualify for the mortgage credit certificate. And just if you just want to Google search mortgage credit certificate /DC, you'll learn all about it on the DC website, housing website. That brings the payment mark down to $2,140.
Okay, you can't rent very many things for that much money in the neighborhoods that we're in currently.
No, I mean, one bedroom start at $2,800.
Yeah, especially at Logan Circle area, you're lucky.
And then there's another advantage on top of this. When you buy a property in the district, just like you buy a car, you pay a tax. Okay, right. Everybody pays it's a purchase tax, sales tax. In DC, the buyer and the seller split the tax of 2.8%. So the buyer's paying 1.45%. Again, there's income thresholds on this, roughly about $150,000. So if you make below $150,000 and you're a first-time home buyer, you can't have owned a home before, DC will drop your part of the tax to 1.1%. That's an additional savings that is on your closing costs. So you're not just getting the monthly savings, you're also getting the city that's giving you an incentive by taking money off the tax of buying the property.
Now on the, I believe they're splitting that recordation, whatever it is.
The recordation transfer is being split. But
then DC's splitting the recordation again for this program, right?
That's correct.
Yeah. So what if there's two people that's going to buy the property? Then both of those incomes together need to be underneath that
It's roughly $150,000.
Okay.
Neither one of those buyers could have owned a property before.
Okay, got it. Yeah, someone was asking me about the limits the other day, so it's nice to know.
Again, everything that we're talking about is Google steps away. My 5.5-year-old son, every time he asks me a question, and of course a lot of times I don't know the answer, he says, "Daddy, Papa, we need to Google search that." Google search DC recordation tax first-time home buyer. And it's right on the DC website under real estate property taxes, and you'll be able to read all about it.
It's a great program. I'm glad that they have it out there for us. Let's go on to, I've noticed that there's been some 3% down payment conventional loans coming about. I think when I mentioned this to you the other day, you said that there's some restrictions on that.
Yeah, let's concentrate just on Fannie Mae. The product's called Home Ready.
Okay.
It's the one we've just been talking about. It's not an FHA type product. So the advantages of Home Ready, if you qualify, as we just mentioned before, 3% down, reduction in your mortgage insurance. So there's an advantage with Fannie Mae. This is a federal program. They reduce your mortgage insurance monthly, or let's say your yearly premium. You also get a reduction if you're buying a condo. So if you don't qualify for Home Ready, there's a interest rate increase with condos less than 25% down. We see a lot of the $450,000 price range being more condos. Fannie Mae doesn't require us under the Home Ready to add roughly about 0.25% to the rate. There's also a reduction on credit scores. So Under regular Fannie Mae programs, they require us to increase the rate if your credit scores are below 740. Under the Home Ready program, you only need to have a 680 credit score or higher to get the same interest rate as somebody who has 780 credit score.
That's great, but is that the minimum that your score can be to qualify for the program, or does it put you in another bracket?
It puts you in another bracket, but
okay.
to be able to get the best financing, if you can keep your score at 680 or higher, that's the way to go.
Okay.
And I always advise people, just quick, Mark, it can't be soon enough to work on your credit and to figure out what's going on with your credit scores. I always tell people, don't go ahead and do a hard pull with a lender right away. Go ahead and get a sense of where your credit scores are by going on creditkarma.com or creditreports.com.
People can be surprised on what ended up on their credit, and they didn't even know it, whether it be a medical bill or something that you missed the payment of by just a few days. And you can usually clear those things up pretty easily by contacting the credit bureaus.
Yeah, the sooner the better, though, because when clients come to us 30 days out from a closing, it's harder to get that stuff resolved as opposed to getting it done 90 days before, even looking at a property. Because if you write to those credit companies and they don't respond to you in 30 days, they have to remove them.
Right. And there's your score correction right there.
Yep. And also paying down credit card debt. If you can get your limits down below 50% of your total amount borrowed on that credit card or limits, that'll help your credit scores as well.
Oh, that's good to know. I had heard 30% at one point, but maybe 50 is supposed to be the goal.
30 to 50%.
Okay.
Definitely better with 30% if you can get it down that low.
Let's talk about, you have a lot of programs. First Savings has a ton of products out there.
Correct.
Do you have a product right now that you're using that you really love, or that you think that's super beneficial to a buyer?
Okay, so I've been at First Savings for 20 years now. That's a long time of my 30 years in the business. The other 10 years is at Bank of America. First Savings.
I don't think I knew that.
Huh?
I don't think I knew that.
Yeah, 20 years. I just hit 20 years. And First Savings is a local, privately held company. All we do is mortgages. We don't do banking. We don't do anything else. So our concentration is on local underwriting, local processing, and working with our buyers to get the best products out there. Right now, we have a flat yield curve. It's actually almost inverted yesterday, where short-term interest rates are almost as high as long-term interest rates. So if you had come to me a year ago, Mark, or anybody came to me and said, what's better, a 7 fixed-year ARM? So it's these hybrid rates that are only fixed for 7 years, and they convert into a regular moving adjustable rate mortgage or a 30-year fixed mortgage. I would back then say, hey, nobody stays in a property more than 3 to 5 years.
Right.
I would do a 7-year fixed. In today's market, with rates not being that much more beneficial with these hybrid ARMs, 30-year fixed really looks more attractive, or as attractive as the ARMs. So if you were to say to me, what's the best product out there? I always say for first-time home buyers, there's a good chance you'll hold on to this property and rent it out. It's a great investment. Real estate is a tangible asset. Mm-hmm. I right now would say 30-year fixed is the best product out there.
I would agree. Yeah, I've looked at those adjustable rate mortgages, and sometimes I have some couples going into a 1-bedroom and they're trying to pick their product, and I'm like, you're going to sell this probably in like 3 to 5 years, so use an ARM. And the last time I got a rate, it was kind of a no-brainer. This way, use the 30 fix.
The Fed's raising rates. There's been a little bit of instability in the stock market. We have a drop in 790 points. What's happening is the Fed raises rates, and the longer-term interest rates based off the bond market, the long-term bonds, 10-year bonds, they're coming down. So there's almost no gap between the ARMs and the fixed.
It's great that we're not putting people in the position of being an adjustable rate that's going to end up way farther than where they started from. I have a lot of clients that are consultants or work in a business that they get a yearly bonus. So they have W-2 income, and the end of the year they might get a Christmas bonus, or in January they might get a sales bonus.
Yep.
What does the approval process look like for people in that situation?
Okay, so the industry in general, Fannie Mae guidelines, which everybody follows, 2-year history of bonus income. So if you're a hygienist and you're working for one dentist and you've gotten a 2-year bonus, we can count that as part of your income. As long as you have not written that income, that bonus income, off to any expenses related to your job, we can use it. So I have a situation now where a client has left one job and went to another job. A processor who went from one mortgage company and got offered more money at another mortgage company with potential for bonus. Okay, so we were still able to count that bonus income from the old job because her employment contract stated she was going to get the same number of, if she were to produce a certain amount, she'd get that much income. I have another client who is a hygienist, and that's why I brought that up. She actually worked for one dentist for many years, went to a new dentist, and she's already had a year of bonus income. So we have a 2-year history, one from her old job, one from her new job, and we can continue counting it. And that can be counted towards your regular income. So you can actually add it. So if you're making a $100,000 base and a $20,000 bonus, and you have a 2-year history of it, we can count your income and use $120,000.
That is great to be able to use. If it's, let's say someone is a first year, they work for, I don't know, say they work for one of the consulting firms, and they've had one single bonus. So you don't have 2 years. Are we just using their W-2 in that case?
In that case, we can only really use their W-2.
Okay.
The only way we're able to use the bonus income is if we get a letter from the employer stating that it's a guaranteed bonus income and that it will be paid out the next year. Now, if you look up the term of bonus income, if you were to Google search it, there we go with that word, Google again. It's based off performance, previous years or during that year's performance. So really, bonuses aren't guaranteed. They're based off performance. So, you really, if you only have 1 year, let's say things aren't as productive the next year in your business, you may not get the bonus income, so we really can't use it. So we do need a two-year average.
Okay, so I'm gonna stick with that as my answer to those clients.
Yeah.
We have a couple minutes left. If anyone has any questions, then feel free to post them here. And if you're watching them when we are not live, you can make comments on this thread, and myself or Greg will reach back out to you. Greg, I've noticed there's a lot of new construction around town, and I noticed that you're a preferred lender for a lot of these new construction products. As a buyer, what is the benefits of using someone that is already a preferred lender in a new construction project?
Okay, so working with a preferred lender, and I'm on many projects.
You are.
You reviewed the condo docs. You run it through to get warrantability in your company, meaning that it's going to be able to be sold to Fannie Mae and Freddie Mac. You're familiar with the sales team and the developer. We always need to get updated information, for example, on how many units have gone under contract, how many units have been sold to bona fide owner occupants or second home residents versus investor, people renting. So in order to lend in a building and get regular 30-year fixed Fannie Mae rates, you have to have pre-sales normally over 50%. So we get this information quickly. We work closely with the sales agents. We know the builder to get the project, for example, if somebody wants to do VA or FHA, we work closely with the builder at the time to get those projects approved that way. One more thing I want to mention is we work with these builders' attorneys up front when they're doing the condo docs and the developers are building the buildings to make sure that they build to meet Fannie Mae and Freddie Mac guidelines and make sure that the condo documents are meeting Fannie Mae, Freddie Mac, VA, and FHA guidelines.
That is good information, and you certainly know your way around new development. Yes, you're, like you said, you're married to a developer, a very good developer, if I might add. We are right at the end of our 20-minute session. Just want to say thank you, Gregg, for joining us today. I'm going to have all of Gregg's information right here on this thread. Feel free to reach out. And if you need anything from me, dcrealestate.com. Happy Friday.
Thanks.